Hello traders, Gary Wagner here. It is 12:30 in Honolulu, 5:30 in New York on Wednesday, 26th day of February 2025, and this is the evening report for gold and silver. Gold futures appear to have stabilized after yesterday's strong $40 price decline. Trump's threat of a spreading trade war would definitively challenge and diminish the global economy and boost inflation, and that is unsettling on market participants and consumers. Until market participants have more clarity as to next week's action regarding tariffs, gold will be highly supported by the need for a safe haven asset. Gold recovered very quickly after yesterday's $40 price decline, with the most active April futures contract gaining $3.10, a gain of 0.11%, taking a troy ounce to $2,931.70. That occurred along with dollar strength. The dollar gained 0.22%, taking the index to 106.43. Many analysts believe that yesterday's $40 price decline, which occurred after gold hit a new all-time record closing price at around $2,974 on the prior day, was a signal that a correction was imminent. At least for today, gold has found support. We have an inside trading day in which gold traded to a lower high, a higher low, and a higher closing price relative to yesterday's $40 decline in New York trading. Ever since gold closed and broke above the all-time record high and closing price at $2,800, as a market technician, we had relatively little data to reference current pricing against. The fact of the matter is we are in uncharted territory and have been for the last 4 months. However, what we can do is look at the two major rallies that occurred last year, the first one in February and the second one, which began at the end of July, and compare it to this current rally and measure the angle of ascent, which is the small numbers here. The angle of ascent is 29.12 degrees. The angle for the July rally was 30.59 degrees, and the angle of the February rally, 33.34. And our conclusion is obviously that the angle of ascent has been very similar in all three rallies. However, there is a notable difference in the stochastic oscillator, which compares the current price to the highest highs over a specific amount of days. And it is within the stochastic study that we can observe a very big difference. And the difference is how long gold has remained overbought during this rally compared to the two other ones that we have been using as a historical reference. It is much longer.
Let's take a look at the time period for which gold remained in the overbought territory. It began around January 15th and concluded around the 25th or the 26th. That is a month and 10 days that gold spent above 80 on the stochastic oscillator. To illustrate how rare that is, we actually have to go back all the way to 1980 to find a period of time in which gold remained overbought for such an extended period of time.
The last study I want to look at on today's show is the MACD, the Moving Average Convergence Divergence, and the fact that what we are witnessing now is a signal line crossover. And that is because we have just seen a signal line crossover, and we have seen
the histogram
move from green to red, and that could be significant. This has been Gary Wagner wishing you, as always, good trading. We will talk to you tomorrow for the next daily update and review. Bye-bye.